I don't think it's confusing at all. It's actually something I've actually suggested to Bitcoin treasury companies before this point with the other offerings. And the reason why I have is that don't think of it as buying the competition. Think of it as a company having different securities holdings in their treasury. Now, you can say that Stretch is a competitor to SATA, if you it is. However, in terms of capital management, in terms of maintaining and growing a capital stack, you wanna do things in a way that makes it sufficient, and you wanna do things efficient, and in ways that can make it self-sufficient, that you have different holdings that help you maintain the capital stack that you can leverage and appropriate in different ways. In my view, corporate adoption of the preferred offerings is another wave of adoption that we're gonna see. I see a future where companies outside of the Bitcoin treasury companies outside of this space will hold Stretch on their balance sheets as just another holding. And I think that that is a natural progression for the offerings. If you take a look at all the companies that exist in the world right now, they hold all kinds of different securities, equities, and assets in their corporate treasuries. It's just not something that is broadcast, but it's something that exists. The reason why it's getting attention here is because this is a very, very nascent space that's still growing. So Strive buying Stretch as part of their corporate capital stack, it's not that it's not that surprising to me. I thought it was going to be a natural progression. They are just the first one to do it, or one of the first ones to do it, rather, because there've been other companies that have done it, like Orange and a few others.
That it's I guess it's just hard for me to think about like that. Is is there any way or like any world where you see strategy doing something similar, buying a preferred from another company?
Well, if you think of it, they are, and this is why you have to think of it. I think of it a little bit differently in terms of, is this competition or is this just strategy has built the market and now Stretch and other companies are participants in the market. I think that what strategy has done is they've built the market, right? They have um, created the offerings, and now the market is doing what it does. Participants are coming in, and they're deciding how to be participants in the market. So I don't know if strategy benefits or has any incentive to participate in the market they created. Right? They've created the market. They are the market. Therefore, they're not incentivized to become participants in that market. I don't know if it would make sense to them. Now, could they do it in the future? Theoretically, perhaps, but that's just the way I view it. If I were to create a market, if I were to become the person that creates a new offering, creates a new series of products, and so on and so forth, that then attracts market participants, I am then not incentivized to participate in the market that I created. But that is just my opinion.
Yeah, it's interesting, and I guess it's also a very early space where we will see a lot of things developing, and the space probably looks very different in 5 years than it looks right now, and it will look very different in 10 years again. It's very nascent space.
Yeah, absolutely. And we're gonna see growth. We're gonna see different adoption patterns. We're gonna see different, um, you know, offerings. We're gonna see a lot of change. Right now, the preferreds are less than a year old, right? So we can't really make too many assumptions about where things are gonna go, other than typically for these kinds of offerings, it takes 3 years, 2 to 3 years for the market to view them as steady state. I don't know if we can assume that it's gonna take the same 2 to 3 years considering the Bitcoin, collateralization and the relation to Bitcoin. But again, that's all, um, the different kinds of narratives and different kinds of realities that the market's gonna reconcile over these next 2 to 3 years as these offerings, especially Stretch and SATA and others, stabilize, get to steady state, and then and have a market presence.
That's crazy. Um, Like it's so interesting for me, the whole space, and but I want to get another topic in today, even though I have like a million other questions around strategy. Maybe it ties also interesting in strategy and Bitcoin also in, because you wrote a piece on sentiment, and I just saw it right before we started the recording. So I was just putting it into the robot and asked the robot, hey, what are like the 10 biggest takeaways from that? And just that was really intriguing for me. And so the piece was something called with sentiment, an expanded thesis on markets and valuations, something like that. What is it about, and like, why did you write it?
So the two words that you can take away the from the title is without the adjacent is sentiment as substrate. So what I mean by that is my based on my experience in the market, based as someone that has been investing for over 20 years since he was a teenager, as someone that has been observing markets for a very, very long time, my view, and I think it is supported by both reason, experience, and information, is that markets are fundamentally driven by sentiment. Sentiment is the first impulse, the first cause of market action. And what do I mean by that? I often walk people through a thought experiment to help them understand where this is coming from. They often say that markets are forward looking, right? So what that means is you allocate capital today for an outcome tomorrow. That's the very, very simple way you can think of it. But we can't objectively know the future. So there's no objective information from the future that can possibly inform our decisions today. Therefore, how could our decisions in the market to allocate capital be objective? They can't. Fundamentally, by definition, logically, whichever way you want to spin it, a allocation of capital cannot be an objective decision. So the way that we bridge that gap between what we know today and what we hope to happen tomorrow is sentiment. Now, people think of sentiment as emotion, but that's actually not an accurate definition. The way I structure sentiment, just based on the research I've done on this and based on the way that I understand these concepts, is that sentiment is fundamentally a dance between perception, judgment, and conviction. Perception is how we perceive the market. Perception is how we perceive information. That is not done in a vacuum. We do not look at something without our own subjective bias, our own experiences, our own opinions informing how we view it. Because information by itself is inert. Information by itself has no qualities whatsoever until we project those qualities onto it when we perceive it. That is the act of perception. The judgment aspect is now that we've perceived the information, we are making judgments on it. It is impacting our decision making process. We've received the information, we've taken it in, we've internalized it. Now that's going to drive our decision making process. So that is a link between perception and that's a link between judgment. Conviction is where the allocation of capital happens. You can perceive this information, you can make judgments on the information, but in the market it means nothing until you allocate the capital. So sentiment isn't emotion. Sentiment is perception, judgment, and conviction leading towards allocation of capital. And that is why, very, very fundamentally, the market is sentiment driven. If allocations of capital are forward facing, if they are future oriented, they cannot possibly be objective. There's no way for them to be objective under that kind of a structure. So what that leads to is if all allocations of capital cannot be objective and they are in fact sentiment driven, what that means is the entire bedrock of the market is subjectivity. It is sentiment. That is what's driving all action in the market. And I would often get challenges to that people say that they talk about, well, trading algorithms. Okay, does a trading algorithm act independently in the market or does it act autonomously in the market? I would say that it acts autonomously. It is not independent. Independent means it acts like you and I. We decide to make a decision, we make the decision. An algorithm is operating off of rules and constraints. It reacts to the market. It doesn't set the market. What about passive indexes? Same thing. What is a passive index? A passive index is a price taker. A passive index goes into the market and gets gets allocations based upon the prices that are set at market. There are all kinds of different ways that we can think it through, and that's just me kind of giving like a 2-minute distillation of it. But the essay itself, the thesis itself, is over 30 pages, and I go through a very, very detailed breakdown of the efficient market hypothesis. I go through reflexivity. I go through passive allocations. I go through trading algorithms. I go through the flaws in each concept. I go through how sentiment impacts all of them, how sentiment relates to volatility, how sentiment relates to risk allocations. I go through a very, very systematic breakdown of all of these concepts and how sentiment plays into them. But the overall thesis is very, very simple. If sentiment is the fundamental impulse for the market, which I challenge anyone to come up with a way to undo that logical conclusion, that means that everything in the market is downstream of sentiment.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. Is sentiment kind of downstream from narrative? So like the
No,
sentiment in this market is?
no. So how does a narrative form without sentiment? And that's the thought. That's the other thought experiment that I actually have in the essay. It really goes sentiment, narrative, price formation. Because people talk about narrative and people often say that, well, narrative follows price, right? The price is set, the narrative follows. That's actually incorrect. Because if we think about it, and just think about it very, very logically, is price something that exists in the market in and of itself? Does price just happen? Does capital allocation just happen? If the logical conclusion of sentiment being the first impulse, what that means is price can't follow narrative. Narrative doesn't come after price. Price comes after narrative. Price is something that is a function of sentiment, and narrative is also a function of sentiment. A narrative can exist with or without price, but price cannot exist with or without narrative. Price is not something that exists in the market by itself. Price is something that's set by the market. And if the market is fundamentally sentiment driven, that means that price is a function of sentiment. And what that means is sentiment builds narrative. And what that means is price is a function of narratives in the market.
So just for me to understand it correctly, let's say that is for every kind of market. So it's like Bitcoin strategy, like all stocks, like this is kind of like a thesis for all assets that kind of have a price. Are also commodities and like, I don't know, milk and stuff.
Well, milk is, I don't know if we want to use milk as as an example, But if we use commodities, it's very, very similar. If a commodity was priced at the cost of production, at the cost of extracting it, so let's use gold. Gold isn't priced at the cost of getting it out of the ground. Gold trades at a premium, and it can trade at a discount. And another thought experiment that I have in the essay is, if something is trading at a premium or a discount, that can't be anything but narrative driven. Why would the market rate something less than it's worth, and why would the market rate something as more than it's worth? And people often come up with a lot of, ways to justify it. But again, sentiment is the first impulse for market activity. What People don't buy gold because they think that it's worthless. They're obviously expressing a preference for a price point when they buy gold, and that is what drives the price. So my formulation, people often go through a epistemological view, focusing on what they can know and what they do know and what they can observe in the market. My view is ontological. I take a view that focuses on what is necessary for the market action, what is necessary for first cause, what is necessary for the action to take place in the first place. That is sentiment, because if we were to remove humans from the market altogether, market activity ceases, right? So therefore, the impulse is always human sentiment, human allocations of capital today for outcomes tomorrow. And again, I'm really distilling it down, because if I gave you every aspect of the thesis, we'll be talking for the next 3 hours. But just think of it very, very simply. Just if I had to give someone one point to focus on, it would be uncertainty. If we are making decisions today for a future outcome, that decision cannot be objective. That allocation of capital, since we cannot know the future, cannot be objective. What that means is price is a market is a market outcome, right? But it is not an objective market outcome. It is an objective result in the sense of a price is set, but it is not objective in the sense of it is a concrete result that is absent of sentiment, that is absent of subjectivity, that is absent of anything else. The impulse for the market is always sentiment driven.
What does, or like, how does this impact average investors that now try to make decisions where to put capital, where to put the next dollars that comes in with the income that they have?
I would say informational density. You want to have an allocation of capital towards something that has a durable narrative. If you think of it in terms of you're trying to identify intrinsic value, which I also go into in great detail, you're kind of chasing your tail. If the logical progression, if the actual informational progression, if the consequences of everything I'm saying is true, allocations of capital are not towards a definition of value. It is towards a definition of a durable narrative and what will attract capital. So if we were to use Nvidia and the AI trade, right? They've been calling for a bubble now for years, but the bubble still continues. What that means is it is a durable narrative. Now, does that make it an indefinite narrative? No. And that's why I talk about informational density. The more well informed your decision is, the more well informed your allocation of capital is, the more durable the narrative is around that allocation. And that is what should drive the decision. We are looking towards identifying durable narratives in the market, not through a essentially self-defeating search for value. Because if Nvidia, using that example again, is seen as valuable today, but something happens in the market and it crashes by 50%, is it all of a sudden not valuable by 50%? Or just has the narrative shifted? Or perhaps is the narrative not as durable as we thought it was? Do you see the distinction? You cannot possibly know the future, but what you're trying to do is you're trying to allocate capital towards that uncertainty. And the only way you can do that is through the finding out what has durable narratives. And some of the most durable narratives we've seen in history, if you want to go back to commodities example, you have gold, you have silver, so on and so forth. We are now we are existing in a market where the narrative durability is constantly being tested. And the companies and the equities that survive are the ones that have the most durable narrative.
Is there an impact that now AI has on capital allocation because it brings this information density faster to individuals? Like you can dive deeper into topics faster and more accurate than like 50 years ago?
Yes, it does bring informational density into play much more quickly in a way.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relay to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relay, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called micro-seed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With micro-seed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io.